past 3 years, and I just wish at some point someone would have just sat me down and explain all these different types of loans or financing terms that are so crucial just for everyday purchasing. And people always would say, hey, if you want to get in real estate, you got to get a real estate license, which I disagree with. I don't think every person in real estate needs a real estate agent license. But I figured, hey, why not explore this information and learn how to teach it back to all of our kids? Because how do you master something? You got to be able to teach it. And if you can't teach it at a fifth grade level, then you're not really serving anyone because then you're just trying to come up with all these complicated words and trying to figure out how to complicate everything to and think that that makes you smarter or look smarter. But in reality, it doesn't really help anyone. So today, I'm going to try to come up with analogies whenever I can think of any to explain the different loan types. And the reason I'm doing this because I hope that all of our kids will have an opportunity to buy a home one day, and they should know what type of financing mechanisms are out there, right? That are traditionally out there, not just to creative finance, but what's out there. So whether you're eyeing a comfy family home or looking at an investment deal, I think understanding all these financing options will help you pick the right path. So let's talk about a major loan type today. All right. So you might wonder, hey, why do loan types even matter? Right? It isn't just a loan, but your loan choice will affect very near and dear to you, again, your lifestyle, because it affects your monthly payments. And that can affect how much you can borrow and the total amount of interest you pay over time. And it might even affect how easily you can refinance later down the road or how quickly you can move if interest rates ever change, which if you've been following what's happening to the 10-year treasury yield right now, it's been sliding down from a peak of almost 5% just 2, 3 months ago to I think it was sub fours today, right? And interest rates are driven by two things, right? Conventional mortgage is driven by one, the interest rate on the 10-year treasury yield, and it's driven by the spread between the 10-year yield and the 30-year mortgage interest rates. That is what drives the 30-year mortgage interest rates. Now, the expectation from the Fed cutting rates, does that matter? Yes, it does, but it's not the be all end all because sometimes the bond market actually moves faster than the Federal Reserve. So you got to pay attention to the 10-year yield on the treasury rate. All right. So let's go into the first type of loan. And these are what people typically call conventional loans. Conventional loans are loans that are not backed, they're not insured by government agencies. They usually have stricter rules on credit scores, how much you got to put down for a down payment, but their interest rates are pretty competitive if you qualify, right? And obviously, the larger the down payment you make will lead to a lower monthly bill because you're borrowing less money. But if you put down less than 20%, then you might have to pay an additional monthly insurance payment called private mortgage insurance. That's essentially an insurance premium that in case you default, right? Because if you put lower down payment, then the bank is lending you more money. So the risk goes higher because they are lending you a higher proportion of the value of what the home is worth, right? So, I mean, I try to think about it as if you were trying to buy a bicycle with your own cash. But if you don't have enough, you might need someone to vouch for you, right? That's how I think of a private mortgage insurance. It's almost like a guarantor, right? If you're a kid, sometimes that there is a backstop with your parents, right? Assuming they have enough money to take care of your loan in case you can't repay it, right? Now, the other loan type I want to cover is the FHA loan. The FHA loan is backed by the Federal Housing Administration. And that means that the lender has some protection if you default, right? Because the federal government is insuring that loan. This is there to essentially help incentivize people to build wealth through home ownership. And that usually allows you to qualify for a loan, even though you might have a really low down payment. It could be as low as 3.5%, right? Sometimes we hear a lot about putting 20% down, and that's usually because they want to avoid the PMI payment. But FHA loan, they can go to 3.5%, right? And they could be much more forgiving about the credit score and credit requirements. But you might have to pay an upfront or a monthly mortgage insurance premium for that because, again, the lender is lending more money out, so they are at a higher risk. So they want some sort of insurance policy, right? I like to think of it as the FHA as if you're swimming as a kid, sometimes you might want a floaty or a life jacket because it's going to help you stay afloat even if you are not a strong swimmer, right? But you still have to pay for that floaty, right? You still have to pay for the life jacket. Similar concept. Again, if you have better analogies to explain this stuff, please let me know in the comments because I'm just trying to become a better dad. Coming up with the analogies that a fifth grader can understand is so important. But I'm just learning to get better at these analogies because it's much easier to explain things if you can map it to real life things that they can relate to. All right. The other type of loan, third type of loan is the VA loans, right? For if you are a U.S. military vet or you're an active duty member or maybe you're the eligible spouse of a vet, a VA loan truly can be a blessing because it usually requires no down payment and no monthly mortgage insurance because the Department of Veterans Affairs guarantees a part of the loan so that the lenders are essentially safer, right? And they can pass on those savings to the borrowers. That's why you can have such a zero to, I mean, you have a 0% down payment on a loan, which is crazy, right? All right, so let's talk about the other loan. The other one I hear about a lot is a USDA loan, and that's usually for a rural or semi-rural home. And this is another loan. The USDA loan will offer you zero down payment because, again, this is another government-backed loan that's really targeting that moderate income level buyer who is struggling to secure conventional financing. And with these loans, right, there are location and income rules. But if you qualify, it's a fantastic deal. Seriously. I like to think of it as almost similar to, look, I was on reduced school lunch program, right? It's almost like a school lunch program for certain neighborhoods. You get extra help if your location and your income fits the criteria. All right. Then the other loans are fixed rate loans versus an adjustable rate mortgage loan, or sometimes they might call it an ARM, right? Adjustable rate mortgage. Usually, the FHA, the VA loans that we talked about, right? Some conventional loans, if you want a fixed rate mortgage, right, the same monthly payment for the entire length of the term of the loan, right? That's a fixed rate loan. But if you want an adjustable rate, right, after usually people get an ARM loan because their interest rate starts lower, but it can go up or down over time. What does that mean? It means that typically it might be an interest rate that is locked in at 5% for the first 2, 3, 5, 7 years, but it can go up or down depending on the market conditions. The fixed rate gives you stability, right? But I know friends that are buying homes on using an ARM loan right now because are they have a hypothesis, right? No one can really predict what's happening, right? They have an hypothesis that interest rates will go down in 5, 6, 7 years when they go to refinance because of how high interest rates were just like 2 months ago. Fair, right? But there's risk. So you had to decide what your risk tolerance is. And again, this is not investment advice. I'm not soliciting any investment scam call. I'm not an investment professional. I am not an attorney. This is not legal advice. I'm just simply showing you all how to think through the different criteria that you might want to apply to your decision every single day, especially when it comes to one of your biggest investments in your life for your home. All right. Besides for your car, I mean, a house is essentially the next biggest purchase you typically make, right? And I like to think of it as that you think about adjustable rate, right? It's sometimes you might say, hey, maybe I'll get a monthly bus pass or a monthly train pass, right? That's fixed rate instead of paying per ride, right? A bus pass is steady, you kind of know what it is. And if you ride more than the variable rate, then you're in the green, right? But maybe there's some months when you don't ride as much, right? And that's hard to predict. So same concept with adjustable rate mortgage versus fixed rate mortgage. that hopefully even a kid can understand if they have a student T pass. Well, I grew up in Boston, so they used to call it T, but a standard student train pass, standard student bus pass, whatever you want to call it. All right. So another thing you want to learn or know about loans is sometimes the amount you borrow isn't exactly just the interest rate. You will usually see fees for loan origination fees, right? And this is essentially the money that a lender is going to make just for lending a loan out, right? This is how they get more money up front. Again, they reduce the risk, right? They cover some overhead costs with getting those points charged with what they call as loan origination fees, right? Sometimes you have to pay fees for the appraisal, which means that a bank wants a third party, not you as the buyer, to go out there and assess how much is that property worth because they want to make sure that that home that they're lending on is indeed worth money. Very important, right? You want to pay for credit check fees, all that stuff. So always anticipate there is a certain amount of points or percentage points of your purchase price that you have to just set aside for closing costs. That's just what it is. And sometimes people even buy down the interest rates, what you call it, right? They pay a little bit more upfront so that they can lower the interest rate, especially when interest rates were as high as they were. And if you plan on staying in that home for a long time without wanting to refinance, those points can save you a lot of money over time. So you got to do this over those amortization calculators, those mortgage calculators to help you go through the scenarios of, hey, if I buy down 1 point, right? But my interest would go down by one whole percentage over the life of the loan. How much more money would I save in terms of interest? And you decide how much you want to pay upfront for that savings. And again, right? Everybody's life circumstances change. You might think this is your forever home, but 5, 6, 7 years from now, your life might pivot a little bit. Your family might grow or expand, and things change. So just be very wary about that. All right. So when it comes to just choosing the right loan, we talked a lot about some of the bigger ones, right? We haven't talked about like construction loans and installment payments and seller financing notes. But I think when you are buying a home, typically those are your typical options. So when you're about to choose your loan, you got to really consider about, hey, what's your credit score? How much have you saved for a down payment? How much can you truly afford based on how much you're making right now? Right? Because you don't want to be you can be, but you don't really want to be house poor where you live in a home, but you really don't have any excess capital or disposable income to do anything, to go out and have a social life. Again, everybody has their own preferences. And honestly, only you probably know how long you want to own a property. So if you want to start a home and you think you're going to move in 5, 6, 7 years, hey, maybe an adjustable rate mortgage might be okay right now. But if it's your forever home, you might think, hey, I want a fixed rate mortgage now so that I can have that peace of mind about my monthly payment, regardless of what's happening in the economy, right? I like to think of it as sometimes you might want to think about, hey, what is the best route for my road trip, right? If you want to do a straight shot, right? A highway, a stable highway might work best. But if you want to switch destinations, you want to go in and out, right? Maybe you want some flexibility. Maybe you want to say, hey, I don't want to go on this 2 hour stretch on this highway where there's no hotels where I can't pull over even if I wanted to, right? Decisions. So hopefully this helps you, right? There's no one size fits all mortgage. You and your circumstances are very unique. And whether you qualify for some of those government backed subsidies or insurance policies, that's huge. So it also depends on where you are located because maybe the USDA loan might work for you. There's so many different loan pieces. And if you want me to cover more about loans and the types of loans, please let me know in the comments. I would really appreciate it. Thank you so much for tuning into the live. We've been going live for 553 days now, and I'm always so grateful that I have the support from all of you. I truly am really, really grateful. Thank you so much for caring about affordable housing. Without people like you, I would have never had the home I grew up in. So I appreciate you all so much. And this is my way of giving back to all of you and sharing the knowledge I have gained over time from all of you. All right. So hopefully this was helpful, everybody. Again, if you have questions, please let me know what they are. I appreciate so, so much. And hey, DM me anytime on LinkedIn or on Instagram at InvestorCanHe. I'm here. I read all my messages. I might not get back to you right away because I've been really busy with family, but hey, it's been it's been really fun. And I hope that you will start your own YouTube channel, right? You can literally talk about the same concepts or same ideas as I do and just put it on your own YouTube channel because guess what? Your kids, I really thought about the day I died and I thought, hey, what if I died tomorrow and I didn't leave all this information for them? I would feel really bad. So this is why I do it. This is why I do it. And I hope you all can take this information. Hey, Bernine, Annie, thank you so much for tuning into live today. I appreciate you all so much. These comments mean so much more to me than you ever think. And I am sincere. I really hope you start your own YouTube channel because you got to get started sometime. And your kids will thank you so much, or your grandkids will thank you so much for just trying to explain these really ridiculously hard jargon and fancy words in real estate in your typical normal fifth grade language. All right. Have an amazing Friday, everybody. I hope you all spend some quality time with your family and friends today because that's what life is all about. I hope you all have an amazing Friday. I'll see y'all tomorrow for day 554. Have a good one.